Thanks for tuning in to Business Daily. Coming to you live from Seoul, I'm Lee Ji-yoon. Before we get started, let's see what we have lined up for you this afternoon. Some of Korea's biggest companies are boosting the number of new hires for the country's young people. But some are pointing out that more can actually mean less. Japan lost 2 decades of growth starting back in 1991, and now there are concerns that Korea's economy might face its own lost decade soon, unless it learns from its neighbors' mistakes. President Park Geun-hye has promised to add on 200,000 new jobs for young Koreans by the end of 2017, with the help of the government's Creative Economy Innovation Centers and private companies involved. Speaking at a Creative Economy Center festival in Daejeon, the president said the 17 innovation centers, along with private firms, should take part in building a stronger foundation for growth. While emphasizing the importance of the centers, the president asked related businessmen to identify regulations that hinder growth and find ways to improve the system. The festival was held to celebrate the completion of 17 innovation centers across the country, considered the backbone of President Park's drive to build a creative economy and help get local startups off the ground with the support of larger firms. Korea's biggest business groups recently announced that they will be creating tens of thousands of new jobs for the country's young people. Now, on the face of it, the figures are quite impressive. But experts say that if you scratch the surface, most of the positions leave a lot to be desired. Our Song Ji-sun reports.
200,000 new jobs. That's the ambitious goal set by the government and the private sector to tackle Korea's soaring youth unemployment rate. Following the government's announcement last month, conglomerates like Samsung and Hyundai Motor have unveiled plans aimed at recruiting a record number of new employees. Some of Korea's biggest business groups are announcing plans to hire more young people over the next couple of years. They are responding to the government's call to join the initiative. Korea's youth unemployment rate hovered in the 2-digit range in the first half, the highest since the global financial crisis in 1999. With the retirement age extended to 60 starting next year, the public and private sectors are also joining hands to implement a so-called wage peak system to make room for the next generation of workers. However, only 38% of the 200,000 new jobs will be full-time positions. The rest are mostly internships or trainee programs, with some matching graduates to subcontractors.
Large companies are just publicizing the number of new jobs. When I look around, my older sister and other graduates are struggling to find a full-time position. I worry the job market will be even worse when I start looking.
New hires must come from new businesses and investment, but these pledges are not based on specific investment plans. The new jobs will only divide the work of existing positions. I'm afraid the quality of these jobs will not satisfy young job seekers.
Experts suggest the government subsidize salaries for new employees like in Europe to improve the quality of the new positions. Song Ji-sun, Business Daily.
The South Korean government is feeling the need to boost the country's military strength in the wake of a recent exchange of artillery fire between the two Koreas. So today, Seoul's finance ministry announced that it will allocate more of next year's budget to military spending. Our Shin Se-min has more on this story for us today.
Seoul's finance minister Choi Kyung-hwan says the government is planning to increase military-related spending in 2016 to boost the country's readiness against North Korea's armed forces and provocations.
The government will enhance military strength on the demilitarized zone and anti-submarine front while increasing investment in national defense expenditure.
Talking to top economic policymakers on Thursday, Choi said building up South Korea's military capabilities should go in hand with efforts to expand ties with the North through projects such as building a peace park in the demilitarized zone and reconnecting the Gangwon Railway that runs from Seoul to the eastern port city of Wonsan in the north. In terms of budget allocation, the government said it aims to lessen the financial burden by including this year's $9.8 billion supplementary budget in next year's plan to avoid compromising the country's fiscal soundness. Che added the government will try to maintain its momentum in economic recovery, aided by the recently implemented extra budget.
The government will take a more realistic stance by making conservative economic growth and tax revenue forecasts to prevent the repetitive tax revenue deficit.
A large chunk of the budget will be allocated to youth unemployment, while the government continues to drum up support for reforms in the labor market and has vowed to strengthen the safety net for workers. The ruling Saenuri Party and the government will need to iron out differences before submitting the final budget plan to the National Assembly early next month. Shin Se-min, Business Daily.
Now, developing countries already experiencing slow growth are increasingly concerned of the ripple effects coming from China. Along with falling oil prices, it's especially affecting those exporting raw materials. Our Kwon So-ah reports.
China's latest stock crash has not only caused volatility in some of the world's biggest markets, such as the Dow Jones, FTSE, Nikkei, and DAX. With the country's recent depreciation of its currency and weak growth forecasts for this year, it looks like a big toll will be taken on emerging countries. Financial market figures show the 10 countries most affected, particularly those heavily reliant on the export of natural resources, as China is the world's largest importer of natural resources. Global crude oil prices dropped further to a 6-year low in the wake of China's stock meltdown and are adding to economic woes. Low demand and weak price competitiveness are adding to difficulties in Russia and Ukraine, where things haven't been good due to sanctions imposed over the Ukraine crisis. South American countries such as Brazil, which exports most of its raw materials to China, are feeling the pain too. Same goes for South Africa, another big partner of China. In Malaysia, Indonesia, Thailand, and Turkey, there are concerns that multi-year low currency values against the US dollar could even lead to financial crises. The CDS premium for developing nations, an index representing the credit risk of a country issuing bonds, has jumped up to an average of 6-fold this year. Some say the anxiety doesn't need to be too big.
I don't think current uncertainties will lead countries into bankruptcy. Crude oil prices and currencies have already hit extreme levels, but it's possible things will improve once the US decides on its key interest rate hike.
If the central bank does raise the rate in September, experts say another round of shockwaves will be in store, especially for developing countries. Kwon So-ah, Business Daily.
Korea has cut consumption taxes on cars, large household appliances, and certain health supplements starting this Thursday by 30% through the end of this year. This comes as part of the government's efforts to stimulate anemic consumer spending, which was hard hit by the MERS virus that broke out in May. The tax base for goods like furniture, cameras, watches, and bags has been pushed up from $1,600 to $4,200. Now, the government added that it will encourage large retailers and supermarkets to launch a Korean version of Black Friday, offering big discounts nationwide for about 2 weeks in October. With Korea's household debt hitting record high levels, there are growing concerns that Korea might risk reprising Japan's so-called lost decades. Take a look.
During Japan's so-called lost decades between 1991 and 2011, the country suffered from more than 20 years of a stagnant to recessionary economy. It all started when record low interest rates fueled stock market and real estate speculation, sending valuations soaring. In an effort to stem rampant speculation, Japan's finance ministry raised interest rates, which then quickly led to a stock market crash and a debt crisis. And now there are concerns that Korea may be walking down a similar path. Latest numbers show that Korea's household credit reached $947 billion at the end of June, recording the fastest on-quarter growth since records were run in 2002. Mortgages make up the biggest portion of household debt, with people borrowing more to capitalize on the record low interest rates. And experts say although household debt itself won't spark a financial crisis, when coupled with other external risks from home and abroad, the Korean economy may take a turn for the worse.
And to tell us more about this, we're now joined by Professor Shin Se-don of Sukmyeong Women's University. Thank you so much for joining us today.
Pleasure.
All right, so let's first begin with the current debt situation here in Korea. Where does Korea's household debt stand as of now, and why is it growing at such a rapid pace?
Well, the total size is about 1 quadrillion Korean money, which is very difficult to even pronounce, which is about equivalent to $1 trillion. And if you look at the numbers, the growth rate of household debt has been in parallel with the real growth rate. Of course, there has been about 3 percentage point difference, but always the growth rate of household debt is in parallel with the GDP growth rate. But since the third quarter of last year, right after the Prime Minister Choi Kyung-hwan took office, there has been divergent change in the sense that the GDP growth rate has been falling, but the pace of increase in household debt is surging almost to 9% last quarter. But historically, you can find many other periods, for example, in early 2010, where the growth rate of household debt has been even faster than today. So, so if you look at just a couple of quarters, it's kind of alarming. But historically, the pace of current stage of 7% increase or 9% increase in household debt is not as alarming as many people believe.
All right, but then like we saw in the report, the household debt itself won't really spark a financial crisis. But when it's combined with external risks, like a U.S. rate hike that's expected soon and also a slowdown in China, those are the things that could impact the economy once it's combined with the household debt. What's your thought on that?
Well, many people are talking about the size and the pace of growth of household debts, but I don't think it by itself is going to be a major threat to the Korean, system security. But about 20% of the house debt is taken by the people with actually no income.
Right.
So they are unable to pay even at almost the current interest rate. So if the global rate starting from the United States beginning to increase, well, the pace of U.S. rate hike and how long would it last? That will be a driving force for the global interest rate, and Korea could not avoid raising market rate. So in that kind of situation down the road, I think about 20% of the households with too much of household debts will be a potential threat to Korean stability economic.
All right, then how well do you think the Korean government is dealing with this whole household debt problem?
Well, household debt is a transaction between the private sector and the banking sector. So the fact that it has been increasing at a very alarming pace is not something that we could blame government for. So I think government, the only thing that we could point out is that government has pushed for lower interest rate, historically low rate. So that might be a kind of a stimulating factor for the increase in the debt. But I think the prime responsibility lies first in the banking sector, and the second, the private sector, who try to speculate on the future rise in the house prices. So I think the blame should be, on the banking sector as well as the private sector who want to speculate on the housing.
All right, we talked a little bit in the report about Japan's lost decades. How do you think Korea's situation right now compared to Japan's situation back then?
Well, apparently slow growth and slow slumping real estate market. If you just compare two factors, there should be some kind of similarity. But I think current Korean economic situation is way away from lost decades, in the sense that for the 2 decades from 1991 in Japan, the real growth rate of Japan has been in the negative about 80% of the period. And also the price inflation rate has been about 9 out of 10 times in the negative. So far, Korea hasn't been experiencing such a kind of, negative growth rate and negative inflation. So it is too much to say that, Korea is dipping into the Japanese lost decades of a kind. Well, we are heading into maybe, but it's a little too early to tell.
Okay, well, although you said the situations are a little different, but what kind of steps should the Korean government take, though, from here on out?
Well, at the center, as I said, at the center is the competitiveness of the manufacturing sector. Competitive manufacturing sector relies on several things. First, exchange rate should be very favorable. In the case of Japan, since the Abe government took office about 2 years ago, they have been driving for very weak currency, and the result will be beginning to be seen in trade statistics. So exchange rate is an important factor for the competitiveness of the manufacturing sector. And another thing, factor for the competitiveness comes from the investment and the business mind on the business sector. So there has been a lot for the government to kind of encourage manufacturing competitiveness, and that, I think, is where the Korean future relies heavily on.
All right. Thank you so much for your insight today, Professor.
You're welcome.
All right, that does it for now. We'll be back tomorrow at the same time, same place, so don't forget to tune in then. Thanks for watching, and have a great day, everyone.